You're now looking at my acquisition index. This index has a long history going all the way back to 1973 when I first started writing about the Commitment of Trader report. What I discovered in the COT report is basically how commercials buy commodities. They have a certain way of acquiring their positions. I took a formula that I could use to essentially emulate their buying and selling pressures, which I use in futures as well, as you'll see in a moment, and applied that to stocks. And lo and behold, it works really, really well. Let's take an example here with IBM. When the index is very high, IBM has been under acquisition. You can see the index at very high levels here, despite the fact price is holding up quite well. It's under accumulation. That is unique and somewhat different. We're looking at a weekly chart here, and notice virtually every time that we get into this accumulation where they're an acquisition of IBM by large and smart money, IBM rallies. Sell signals in the market are just the opposite. You can see when we had a lot of lack of acquisition, or these large funds were not buying the market at all, in fact, probably selling, and the market declined. We see that again time after time. That's just IBM though. Let's take a look at another stock. Let's take a look at a volatile one, Google. Now we're looking at Google, and you know the idea. When a stock is under acquisition, you're going to see the green line at high levels up here. And notice again what happens when we are at high levels in Google. This is so interesting because it gives us a setup on a weekly basis of when to expect substantial, not just little 1 or 2 day rallies, but really significant rallies in a market, or declines as well. The lack of the ability of these commercials, large interest, large funds to buy suggests we're going to see selling pressures to the downside of the market. It doesn't matter if it's Google or IBM or, well, let's take a look at General Electric. And here's GE, a real bellwether stock. And you know what I've been teaching you here is when the acquisition index is at high levels, as it is here and here and here, we're expecting and looking for trends, significant trend changes to the upside of the market. By the same token, when there's no acquisition in the market, it's been under distribution, we're going to look for declines in the market. And again, you see that it doesn't matter if it's stock, any stock. I've looked at this formula that I've created in stock markets throughout the world, in India and Japan and China and America and South America and Europe. It works on any stock, any place, but it also works on futures. So let's take a quick look at the gold market. In gold, you can see the importance of this acquisition index when it is at high levels. We're expecting rallies in this market. That substantial rally that we saw at the end of 2012, clearly the gold market was under acquisition. And the decline in 2013, well, look where the year started off. There was no acquisition. There had been selling in this market, just as we've seen here, as we saw before the big break in September 2011. Repeatedly again, when we get in this area of acquisition, markets stop, they go sideways, and or they go down. When we get under acquisition in these markets by substantial large funds, it's time to expect a rally. Let's take a look at one more market. Let's take a look at the bond market. Notice how you've seen time after time in a wide variety of markets, and the same thing is true in the bond market. When this market has lots of acquisition being taken, the market being taken under, if you will, taken down by large interest in the marketplace, expect rallies. And when there's not much buying or acquisition in the market, we expect declines. That acquisition index, when it gets high, it's time for these markets to rally. It doesn't matter if price level is high or low. You see again the rally in the bond market and the large rally that we saw starting at late 2013. Look where the acquisition index was here, and up went bond prices. By the same token, when the index is low, we're going to expect declines in the market, as you can see here. So you can see the bond market is setting up for a decline in 2013 because we get into the area where there's no acquisition. There's simply no buyers of a professional nature in the marketplace. So what we have here is a great tool to set up opportunities to expect substantial intermediate term rallies and declines. So if you're looking for a stock or a commodity that you really are very interested in and want to add to your portfolio, but you want to improve your timing to know when and make certain other large funds are in there buying with you, there's nothing better than the Larry Williams Acquisition Index. In 50 years of trading, I have not created a more intriguing, more interesting indicator than what you're seeing now, my cycle forecast. That's the red line. Now notice this extends into the future 3 months. In other words, this peak, which has certainly been taking place in the stock market, was known 3 months in advance, just as this call for a market low in this time period was known 3 months in advance. And the market sell-off that the forecast was showing here should happen In September, well, again, that was known 3 months in advance. Now, it's obviously not perfect, but it has such a great record of showing us 3 months in advance when markets should peak and top for individual commodities or stocks. In fact, let's go take a look at a stock, an active one. Let's take a look at Apple. Here's Apple. Again, remember this peak that we see in the cycle forecast index was known over here 3 months, that's 1, 2, 3 months in advance. The suggestion of a rally coming in June, July, well, that was known in April 2012. Interestingly enough, the big decline that we saw in Apple was correctly forecast. It suggested a bounce in the market and then down again, and at least as this is being recorded, April 15, 2013, that's exactly what had been happening on the cyclical fluctuations, if you will, of Apple. Let's take a look at a commodity too, because as I said, it works on indexes. It works on indexes throughout the world as well as futures. Let's take a look at an actively traded future. Let's take a look at gold. Looking at gold, again, we see the cyclical forecast was suggesting that we should see a peak in gold just about here, a low in gold about here, a rally up to here. And again, it's not going to be perfect, but the general decline that we saw in gold certainly was forecast. And again, the beauty of this, the low here was known 3 months in advance, just as the high forecast here was known 3 months in advance. Recently, there's been a precipitous decline in gold. Let's see what that looks like with the cyclical forecast. Could we have known of this precipitous decline in gold in advance, 3 months in advance? Well, it certainly looks that way because there's a cyclical forecast suggesting a new cycle move should start just about this time period. And as you saw, that's what happened. Another really interesting market recently of that is wheat. Let's take a look at wheat. Here's wheat. The market sell-off in wheat is clearly indicated by the cycle forecast was known again 3 months in advance. Just as this big break that we saw in wheat in the end of March 2013, almost to the day, the cycle forecast we said we should start to drift lower. Now, at times we'll get an inversion in the cycle where if price has been coming down, and the cyclical forecast suggests a peak, that really means that we're going to have a reversal of the cycle, that will have an up move in the market. What I have seen, I just looked at thousands of examples on individual stocks or futures, that we get a great prediction in advance of when markets are most likely to turn, and often the direction, most of the time, the roadmap is also just spot on. It's a great indicator. I think it's one you're going to really enjoy using on your individual stocks, market indexes, and futures. I've always believed that there is institutional accumulation coming into the market. I first worked on this in 1966 when I developed a new form of unbalanced volume. What you're seeing is my new and improved version of unbalanced volume. Basically, I have discovered how the institutions accumulate stocks and futures, and knowing their pattern, we can develop an indicator that simulates their actual buying in the marketplace. It is actually based on their buying in the marketplace. Notice Apple topped out up here, but look at the distribution that was taking place. There was no more institutional buying from this point on in the price of Apple, saying we would and should expect a significant decline, which is exactly what we got. The big rally, the run-up that we saw in Apple, well, look how heavy the institutions came in on the buy side. Well, price in a flat trading range in here, accumulation just came in day after day after day. The top prior to that, we saw the same thing where we have pretty good divergence. Price makes a new high, a lot higher than back here, but we simply don't see that in accumulation. So what this particular index does is it gives us an insight into when the institutions are accumulating and distributing, and when they're aggressive buyers in the market, most all of the time we see rallies. When they're distributing, of course, we see declines. So if you're looking for a stock or a futures, or you have a position in one, this is going to give you an internal view of what professionals are doing in the marketplace. Well, that's just one example. Let's go take a look at a couple more. Let's take a look at soybeans. Soybeans had a monstrous rally in 2012 in May. Look what happened. Well, the market's in a trading range here. It's just flat as all get out, right? Look at accumulation come into this market. Accumulation is already broken out above this peak back here. Well, price is still hanging out in this level. A great sign of accumulation coming into the marketplace. That's what you're looking for in this index. We've seen a stock. We've seen a future. We'll take a look now at another market that people follow around the world, gold. We're looking at gold, and I'm certain you can spot the divergence already. Notice that the institutions were getting out of the gold market. We can see that there are heavy buyers in here. Again, a trading range, right? But look at the accumulation come in this market. We've already broken out above all this old price stuff. Price hasn't yet done it, but accumulation is very strong relative to price. Then gold blasts off to the upside. Then it comes down big time. Why? Well, look what's taking place. On this rally, this flat to rally area in here, the institutions were getting out. They were distributing. You see, there's just no follow through of institutional buying on these rallies. And that explains, I think, in part, why gold came down so precipitously, because there had been institutional distribution of the market. Let's take a look at one more stock. Let's go take a look at a great one the institutions are very active in, IBM. IBM had a great decline in October 2012. Was there anything that could have told us about that in advance? I think so. Certainly the insider accumulation, the institutional accumulation distribution in the marketplace. While it rallied here, we stopped seeing the insiders and the institutions accumulate this market. And this last rally, in fact, they were in fact selling in the marketplace, and down came IBM. Then, as the market based in here and eventually had a big rally, look what was taking place. Accumulation coming into the market, making higher highs. Though price was still locked in this trading range, you can see accumulation was coming into the marketplace. That's what's significant. You'll see it time after time when stocks are under institutional accumulation or futures or an index. You'll see that there's a really X-ray view we have of the market, an internal view by looking at this institutional accumulation index. It'll help you understand the markets and help you spot trades that are going to have the larger moves. The oldest adage in Wall Street is buy when everyone is selling, sell when everybody is buying. But the problem with that is, how do you know what everybody means? Well, my solution to that is what we call the LW Sentiment Index. Basically, it's our attempt at measuring the number of advisors that are bullish or bearish in the marketplace. And when they're all really bullish, the index is real high up here, prices typically decline. Interestingly enough, what you're looking at here is the Shanghai Index. And we're going to look at a moment for stocks in the United States, futures, as well as individual stocks. But you get the idea from China that when everybody is very bearish in the market, prices rally. When they're too bullish in the market, prices decline. That's just the way it is. It's been a phenomenal indicator in China as well as in the United States. I've used this, first wrote about it in a book from Bloomberg, in fact, in 1999. So with a vision of China, let's go take a look at stocks in the United States. Now to prices in the United States, again, we see the same observation. When the sentiment index is very low, we want to be a buyer of stocks in the United States. When it's very high, we've got to be looking out for nasty spills in the marketplace, as you can see. And again, when the sentiment is very negative in the market, we want to look to be a buyer. What I've been able to do here is just make this into a cohesive indicator, so we actually do know what the majority is thinking and actually doing in the market. Are they bullish or are they bearish? And we can do the opposite of them to find much more success in our investing and trading styles. Let's go now from the stock market to an individual stock. Let's go take a look at Home Depot. Here's Home Depot back in 2009, 2010. When was the largest decline? Well, right here. And what happened just before that? Well, everybody got too bullish on the stock. The best point to be a buyer of Home Depot was right here. What was happening at the same time? The majority of people were very bearish in the stock. That set up the buy point. And again, whether it's in China or the United States or an individual stock or a future, I'll show those in a moment, it's been a great setup tool. So if you're looking to buy a stock, your committee, your fund says this is the time to be a buyer of our stock, or we want to be a buyer of the stock, why not wait until everyone is really pessimistic and then step in and buy then? You're buying into weakness, not strength. And you'll see that's really been the best time to buy these stocks. We'll take a look at a couple of active stocks too. Quick glance here at Google and then Apple. Well, let's Google here. And again, we see a great time to be a seller. What do we see? Everybody wanted to be a buyer. They're saying buy. A great time to be a buyer, and the majority of advisors were very negative on the market. And that's when we rallied. Until when? Well, until we got very high readings in advisory sentiment, my LW sentiment indicator saying we should decline. And in fact, we did. You can see how prescient this has been in telling us when we want to be a buyer in the marketplace. So a great tool to tell you when a market is set up. Your market is set up to have a rally or decline. That's Google. Let's go take a look next at Apple. And on to Apple. Again, the best times to be a seller. What happens? Everybody's too bullish in the market. The best times to be a buyer. Everyone's too bearish in the market, and that's when you want to be a buyer of the stock. Especially in this decline recently, we've seen in Apple, very quick turnaround. The advisors were very bearish in the market, suddenly got very bullish in the market. I saw this in Microsoft. Shortly after it peaked, we had a reading of like 95% of advisors were bullish, and immediately the market fell down. You can see that happening again and again. So it's a great tool to help you. You've seen it in stocks. We will take one look at the world's most actively traded commodity, gold. Here's gold. We notice that the index has been in the sell area 1, 2, 3, 4, 5 times. And look what happened following each of those times. Sharp sell-offs in the marketplace. This doesn't have anything to do with trend. Notice the trend was actually quite bearish here and the advisors got really bullish in the market. That sets up a really nice sell signal most all of the time. And the good rallies have come, or the setups, when the advisors are really too bearish in the marketplace. You can see that just time after time. Now, it's not a license to go buy just because of that, but it says if this is an item you're interested in buying, a future or a stock, now you want to apply your short-term trading tools, your trend following tools to get into the market. But clearly, in terms of getting a market set up to rally or decline, there's very few things any better than my LW Sentiment Index. There's been a lot of talk about seasonal influences in the stock market. I'm going to show you the current seasonal influence. I'm the guy who wrote the first book ever about seasonal tendencies in stocks and futures way back in 1973. Now, that work has been carried on by a lot of other people, but they're doing something wrong, and that's why we've introduced in Bloomberg my true seasonal approach. Then that's the purple line that you're seeing. This is the actual seasonal approach we know at this point in time. All of the other seasonal work, including mine done in 1973, took the seasonal pattern up to date and then used that as a seasonal pattern going back in time. In other words, we were using, say, 1980 and 1981, 82 and 83 to show the seasonal pattern of 1975 and 76. Well, we were using data to show or construct seasonals for 1975. We didn't have back then. So we've done true seasonals. This is the actual seasonal tendency up to this known point in time, which makes it much superior. The typical seasonal high has come about the second week of May, as you can see, with a buy point in March and a buy point in late November as well. This has altered a little bit. You've probably heard the phrase sell in May and walk away. Well, in reality, the true seasonal up to 1950 was to buy in May and make some hay. These seasonals adapt and they change. That's why our true seasonal approach, I think you'll find, is far superior to the traditional seasonal approach people are using. The unusual thing about seasonals, I guess, is that we find them in individual stocks as well as futures. Obviously, there's going to be a seasonal in wheat. We'll look at that, a seasonal in gold. But how about IBM? Is there one? Yep, let's go take a look. We're looking now at the seasonal pattern of IBM and the purple line. IBM has made a seasonal low in October most every single year. That's been a great point to be a buyer, even if it's been in an uptrend. There's been some wonderful buy points in October in IBM, and sells usually not too far after the first of the year. I actually did a report on this, I think in 1980, and talked about the strong seasonal pattern of IBM to be a year-end buyer. Another one is Walmart. That's usually a strong buy at the first of the year. So they vary from company to company as opposed to how they report their earnings and when their sales are effectuated. In fact, a good example, that's Coca-Cola. Let's go take a look at KO. Here's Coca-Cola, and as you can see, the seasonal lows come in March about every year. We've seen really nice rallies coming in the market at that time period. Again, we saw that in 2000, late 2012 and 2013. So this is a stock that doesn't have quite the traditional October buy point as most stocks do. And that's interesting because you can determine for your stock when the best seasonal pattern to be a buyer or seller is, so you have some additional insight into how your stock acts in the marketplace. Well, we looked at some stocks. Let's go take a look at a couple of commodity markets. We'll start with wheat, then we'll look at gold. We're now looking at wheat. Notice we had a large rally last year. When did it occur? Well, when the seasonal low was put in. Sell-offs in the market typically take place around the seasonal high in the marketplace. So you get a lot of insight into a commodity when it typically bottoms in the marketplace. And we can also use this on a daily basis in Bloomberg, so you can look at the current price. Is it holding or performing stronger than seasonal or weaker than seasonal? I found that to be a really great tool for trade selection and trade entry. So we have it on a daily basis as well as a weekly basis. You've seen it in wheat. Let's go take a look at it in gold. We're now looking at a daily chart. Remember, I told you I had seasonals on gold for daily or any commodity for daily or stock. So we see that it's typically a seasonal high in here, a bit of a decline, and then a real strong seasonal sell-off, and that's exactly what's been taking place in 2013. The rally we saw last year, well, that's when the seasonal low is put in. Typically, we see a seasonal low in gold in June, July, and the market rallies. So you have a great understanding of these markets by looking at that. Another market with a strong seasonal pattern is bonds. Let's take one last look. Bonds have shown a distinct seasonal tendency. You're looking here at a weekly chart in the bond market going back to 2010. typically, as you can see, we have a seasonal low in bonds and prices have rallied. In fact, they're starting to do that again in 2013, aren't they, at just about this time period. By the same token, selling pressures usually come in about, well, not quite halfway into the year in the market. Not always, as you can see. There's a couple of ways of using this to our advantage. We'll turn to the daily charts in a moment and show you, but the big issue is that there are better times of the year to buy bonds than other times. That's something you need to know about. On a daily basis, there's also a lot we can learn. Let me show you. Again, you see the seasonal pattern or tendency in bonds down here in the purple line, and we see bonds in the white daily chart. And that's a daily chart, not a weekly chart. Now, here's the really big lesson in this using seasonals and actual trading. Notice how much stronger bond prices were here than the seasonal pattern. Though we know there's a seasonal low here, typically prices rally here. The fact we're a lot higher, a lot stronger than the seasonal point, which we should have been coming straight down. We weren't, right? That shows how strong the seasonal buy this year should work. The same thing for seasonal sells in here. We're weaker than the seasonal pattern. The sells will work, and indeed they did. So the daily seasonal can be used in a couple of ways. First of all, to look at the relative difference between the current pattern and the seasonal price, and also as a general idea of when prices should top, when prices should bottom, when we should expect declines in the marketplace. It's been a great seasonal tool for me in the bond market going back since the inception of bonds. I've been trading that long. So it's a great tool. I think it's one you're going to use as well. The Larry Williams True Seasonal. The old adage, of course, is there's nothing more important to a trader or an investor than the trend, but it's really hard to identify trend, especially if you try moving averages, exponentials, all those things. So quite a few years ago, I came up with what I call will trend. Notice as long as prices are above this green line, we're in an uptrend. Then we go into a downtrend. We get above the green line, we're in an uptrend, and just recently, as this is being recorded, we went into a downtrend. We're looking here on daily charts. So what will trend does, it gives you a great idea of what the real trend of the market is. As long as you're above the trend, you want to be taking short-term buy signals as a trader, of course, taking short-term sell signals. The advantage of it, well, it can get whipped on occasion. It has a great ability to ride moves for a long, long time period. Now, that, of course, looking at the stock market itself, the S&P 500, it works great on individual stocks and futures as well. Let's take a look at Google. Here's Google. This is a stock that just captures trends and rides with them a long time. And you can see that our indicator does the same thing. It's able to essentially say this is an area where we're probably going to go into a downtrend, into an uptrend, and into a downtrend. These are long-term trends that it captures. This same tool can be applied on weekly or daily data. We'll take a look right now at Google on a weekly basis to show you what that looks like. We can identify any trend on any time frame with will trend on a weekly basis. We knew in September, late September 2011, that prices were an uptrend, a downtrend. And notice while prices were up and down, back and forth, it wasn't whipsawed. The trend changes again, the trend changes, and the trend changes. That's the beauty of this particular trend following method. There are a lot of trend following systems out there, if you will, that cost $2,000, $3,000, $4,000, $5,000, and they really don't have anything that is superior to this will trend indicator. It's based on a combination of trend and volatility, market expansions of price activity in the market. And again, it works on any time frame. That's a really nice thing about it. You've seen it on a stock, on a future. Let's go take a look at it on a commodity. Let's look at crude oil. Here's crude oil. There's no special rules to this. It's really pretty simple. When we cross below the green line, the trend is down, it's up, it's down, it's up. And again, notice the lack of getting whipped back and forth as so many trend techniques do. And obviously, when you're below will trend, you want to take short-term sell signals. When you're above it, you want to take short-term buy signals. That's the way this index works. It's a great tool to help you make certain you're on the right side of the market, that you can identify the trend in a mechanical and specific fashion. We'll take a look at one more market. Let's take a look at IBM, a great institutional stock, has been for a long time. Does it have trends? Can those trends be followed? Well, let's take a look. IBM's been a great stock, as I said. The point is, when do you want to be a buyer of IBM? Well, notice we got above will trend, which tells us the trend is up. We have pullbacks to be a buyer on, and then all of a sudden, up goes IBM. It's a great trend mechanism to help you ride trends, whether it's on a daily basis, a weekly basis, or your intraday traders. Works really well in intraday of bonds or the S&P 500, the E-minis. It's a really good trend following technique. I'm certain you'll add to your repertoire. We will take one last look at bonds on an intraday basis with will trend so you can get the point. We'll look now at a 15-minute chart of Treasury bonds. Here we are on an intraday basis, again, getting above will trend. You know what it is. We're in an uptrend, opportunities to be a buyer on pullbacks in the market. It just grabs a trend of the market and will help you determining the trend, whether it's intraday, daily, or weekly. You're going to enjoy this indicator. I'm certain of that.